Good morning to all of you. We are once again here with you on behalf of Informatics Ratings and indeed on my own behalf to discuss issue of considerable contextual significance, India at 75. Let me start by clearing a popular misconception. It's sometimes believed that it's only recently that India has acquired its own place in the sun, so to speak. But I am reminded of a very famous, inspiring words of Mark Twain, who made significant contribution in various fields. And William Faulkner described Mark Twain as the father of American literature. Mark Twain said, and I quote, "India is the cradle of the human race, the birthplace of human speech, the mother of history, the grandmother of legend, and the great-grandmother of tradition. Our most valuable and most artistic materials in the history of man are treasured up in India only." To my mind, these lines by Mark Twain essentially capture the idea of India, the wonder that has always been India, and they define in a very powerful manner what India has been all these years. Considered in a proper historical and comparative perspective, if we examine the position of India in the last 75 years, obviously we have scaled new heights. We have made impressive achievements in various years, in various fields. But at this critical juncture, when we are celebrating 75 years of our independence, this is perhaps a time for some introspection, some reflection. What have we achieved in the years of consolidation, and more importantly, where do we go from here? Of late, as most of us are aware, India has been passing through difficult times, times of great turbulence, momentous times, and it's sometimes maintained that India has been hit by what has been sometimes described as the triple whammy. In the last few years, by triple whammy I mean the forces of demonetization, the rolling out of the goods and services tax, and finally the COVID-19 pandemic, which has been sometimes been seen as a once-in-a-century kind of an event. The nearest comparisons which come to mind are the Spanish flu of 1919. Their attempts have also sometimes been made to compare the COVID-19 pandemic in terms of its severity, in terms of its impact, devastating, crippling impact on lives and livelihood, with the Great Depression of 1929 and the global financial crisis of October 2008. But it has been increasingly demonstrated that the COVID-19 pandemic was far more severe, far more debilitating in terms of its impact. But thankfully, the data, information which has been increasingly coming in public domain clearly substantiate the thesis that the worst is behind us post the COVID-19 pandemic, and India is once again on a high growth path. However, there are heightened geopolitical dynamics in the wake of the Russia-Ukraine war, the high fuel prices, elevated logistics and interest cost, volatile capital flows and exchange rate volatility, and the scramble for a safe haven and attendant correction in asset prices. Of late, there has also been some concern about the emergence of newer variants of COVID-19 and monkeypox, which can throw a spanner in the India's growth story. Now let me come to the macroeconomic backdrop of the Indian economy at the present juncture. Obviously, it's no one's case that everything is hunky-dory, and there are certainly challenges confronting India at the present juncture. Some of the important challenges which come to mind are enhancing the share of manufacturing in India's GDP in relation to the share of services, yeah, because this is significantly lower than in low and middle income countries. Need to adequately capitalize on inherent labor and skill cost advantages to develop large scale labor intensive manufacturing, simplifying complex land and labor laws, providing productive employment to absorb out migration of labor from agriculture to the more productive manufacturing and the services sectors, and strong macroeconomic fundamentals including low and stable rates of inflation and a falling fiscal deficit. In the literature on economic development in general and the transformation of developing economies in particular, there has been a significant emphasis on the need to broaden and accelerate the process of economic development and make it more equitable. Towards this end, there has to be a renewed emphasis on accelerating the ease of doing business and reduce the cost by structural transformation while addressing the concerns of health, education, and employment. I am reminded of a very famous quote by Victor Hugo, who stressed long ago: the invasion of armies can be resisted, but not an idea whose time has come. So, to my mind, while accelerating the process of economic development, we cannot be oblivious to the concerns of health, employment, and education, and this is the way to go forward. The Reserve Bank of India's recent annual report is stressed addressing supply side bottlenecks, calibrating monetary policy to reduce inflation and boost capitalist spending. Inflation has been offset partly by removing customs duties on imports of raw cotton, reduced fuel taxes, rising exports, steel duty, restricting sugar exports, etc. But to our mind, these measures have had a limited impact, something like about 60 basis points on the inflation rate. The Reserve Bank of India has warned that higher risk appetite of non-banking financial companies, popularly called NBFCs, led to their size, complexity, and interconnectedness, posing a potential threat to India's financial stability. The RBI reduced regulatory arbitrage of large NBFCs, making them almost on par with banks in terms of regulatory oversight. Some of the real and worrisome concerns include the high level of fiscal deficit. We may end this year with something like 6.9% fiscal deficit, almost 3% current account deficit, a sticky CPI inflation of over 6%. In the last few months, the rupee has been trading at 79 to the dollar or thereabouts. There has been some slowdown in growth and high unemployment. These and other issues need a revisiting of policy options and structural reforms to meet the revolution of rising expectations. One issue which has evoked considerable concern is the issue of inflation. The WPI and CPI spiral causes concern with WPI rising to 14.55% in March and CPI itself at close to 7%, 6.95%. So the government of India took several welcome measures, but it does seem that high and sticky inflation is here to stay. Now, given this kind of an overarching macroeconomic setting, where do we go from here? What could be the growth drivers which need to be provided a renewed trust to take us significantly forward? I think three aspects of the India's growth story which could be identified and isolated are acceleration of GDP growth in an inclusive and sustainable manner to about 8% during FY 2018 to FY 23. There has to be an increase in investment rate from about 29% present level to 36% by 2022-23. Exports have to increase from US dollars 478 billion in FY18 to US dollars 800 billion by FY23. Now all these, especially at the present juncture, may seem to be a tall order, but we in India have always displayed immense dynamism and resilience, and I see no reason why these significant benchmarks are not doable. They are certainly doable. It will require coordinated and concerted efforts by all the stakeholders with a sense of urgency. The IMF revised growth in 2022 from 4.4% to 3.6%. The World Trade Organization's WTO's revised global trade from 4.7% to 3%. India's decelerating quarterly growth 20.1, 8.4, 5.4 and 4.1 need an accent on manufacturing, investment, exports and employment. Now let me come to the role of banks. The role of banks is significant because banks in many ways are a microcosm, are a miniature model of the broader national economy. Now if I look at the position which prevailed at the time of nationalization of banks, 1967 and 1969, there were 8,262 branches of public sector banks, of which there were only 22% in rural areas, with a deposits of rupees 4646 crore, 4,646 crore, and advances of rupees 3,599 crore. Obviously, there was a concentration of deposits and advances to certain sectors, groups and areas. This kind of a situation reminds me of some very famous lines of a Hindi poet, Dushyant, who wrote powerfully, and I quote, "मेरा मकसद नहीं है हंगामा खड़ा करना, मेरी कोशिश है ये तस्वीर बदलनी चाहिए." A rough English translation could be, it's not my purpose here to create a scare, but my efforts are focused on improving the ground realities and improving them for the better. Since nationalization, the number of branches of public sector banks has zoomed to 1,22,000 odd. Deposits have surged to a level of 161,86,588 crores. Advances rupees 115,95 762 crores. So obviously there has been a significant improvement in terms of all quantifiable parameters. But there has also been a significant improvement in terms of qualitative parameters, and banks have made a major contribution as a catalyst, being a catalyst to economic development and structural transformation, promoting savings habits of the people, capital formation and promotion of industry, smoothing of trade and commerce functions, generation of productive employment, supporting agriculture development, proper application of monetary policy, and promotion of balanced regional development. And now, if I were to give you a quick roundup of the banking developments in the last few decades, obviously we will have to highlight the issues of nationalization of banks, liberalization, globalization, which occurred in 1919, amalgamations, mergers and acquisitions in the public sector banking space, and rescue of some private banks. For example, in 2020s, we had the Yes Bank case, Lakshmi Vilas banks. The emerging role of banks at the present juncture has evoked considerable debates and discussions. There seems to be some kind of a consensus that while banks need to support growth, while being wary of trade behavior of entities whose loan accounts were restructured during COVID-19 to arrest slippages, with gradually unwinding measures, some restructured accounts may become insolvent. This is why a strengthening of a regulatory and supervisory framework is on. Any discussion of the banking sector in India would not be complete without a reference to the change in the recovery ecosystem brought about by IBC 2016 Insolvency and Bankruptcy Code, which in several ways marked a paradigm shift. While it's certainly true that the IBC has fell short of expectations, but there is no doubt that it improved recovery ethics and enabling a recovery environment. Another important aspect, particularly in the last few decades, has been the issue of financial inclusion. And here, the Jan Dhan Yojana has played an increasingly important role. Financial inclusion essentially implies both access to and usage of appropriate, affordable, and accessible financial services, deposits, advances, insurance, remittance, digital payments. Financial inclusion has received an impetus in India through the JAM Trinity, Jan Dhan, Aadhaar, mobile movement, new bank licenses for Mudra banks, and the DBT model, direct benefit transfers. These and other aspects have important policy prescriptive implications for the process and pattern of economic growth and structural transformation of India. Now, given the kind of manifold changes which the banking sector in India is confronted with, the financial sector regulators and the government of India have initiated several policy and operational measures. But some aspects which remain to be fully addressed are those of modest capital buffers for most public sector banks, high level of NPAs. But here I would like to highlight that the banking industry, or what is technically called in the language of the central bank, even IBA, scheduled commercial banks, SCB, is not a monolithic category, and there are significant differences across public sector banks and private banks, and even within these two groups. But on the whole, it can safely be maintained that private banks are by and large better placed to withstand the kind of changes which are occurring with great rapidity and force. One issue which has increasingly come in public domain is the issue of heightened risk aversion, which has induced banks to refrain from lending except to better rated companies. While banks have surplus liquidity, several important sectors still do not get adequate credit because of greater risk aversion triggered by demand and supply side shocks, reduced consumer confidence, NPAs, and consequently pronounced risk aversion. Now here I would like to refer to the RBI, Reserve Bank of India's May 2022 report, which has brought in sharp focus the issues of private investment, higher government capital expenditure, improved infrastructure, low and stable inflation, and macroeconomic stability to drive economic growth in these challenging domestic and global times. Now, one aspect which has not received adequate attention in any discourse, in any discussion of the Indian development saga is the issue of credit ratings. Credit ratings play an increasingly important role in the operational framework of banks in enhancing transparency and interdependence of banking operations. This is why they have been used with increasing frequency for different operational and risk management purposes. Given the extensive use of credit ratings, perhaps the time is now appropriate to bring about some kind of a major fundamental changes. I would like to highlight two issues. There has to be a mandatory rotation of credit rating agencies, as is done in the case of audit firms, and specifying ratings by two entities above a certain lending threshold for greater banking comfort. Now let me attempt to highlight what are the major elements of the roadmap going ahead. Obviously, investment has to be a focus area. We have to make coordinated attempts to raise investments to 36% by FY23, raise India's tax to GDP ratio from the present level of 17% to about 22% of GDP by FY23, rationalize direct taxes for both personal tax and corporate income, and ease tax compliance burden. Higher private investment in housing and infrastructure will create larger multiplier macroeconomic effects. Government should exist non-strategic central public sector enterprises, CPSEs, to attract private investment and contribute to the exchequer, enabling higher private investment. Greater efficient financial intermediation could be brought about by improved risk assessment framework for lending. They should make available easier capital, avoid large NPAs, enable alternative sources of credit such as bond markets for India's long-term developments. Promotion of exports and manufacturing required a renewed thrust on logistics, because we have done a lot of ground level studies, and what we find is from a diverse set of data cutting across regions, across industries, is the two factors which reduce the competitiveness of Indian industries are the spend on logistics and the interest cost. Now, in this connection, a series of measures have been implemented under the ambitious scheme of India at 75. The Prime Minister, Mr. Modi, has called his governance model people-centric rather than government-centric, which prevailed earlier. In this connection, the Jan Samarth portal, which is a one-way, one-stop gateway for several government credit-linked schemes, which directly benefits lenders, is an important step. The government's AKM plan rests basically on 5 pillars: freedom struggle, ideas at 75, achievements at 75, action at 75, and resolve at 75. I am reminded here of the stirring words of Iqbal, who wrote decades ago, सारे जहां से अच्छा हिंदुस्तान हमारा, हम बुलबुले हैं इसकी यह गुलस्तां हमारा, यूनान मिस्र ओ रूमा सब मिट गए जहां से, अब तक मगर है बाकी नामो निशा हमारा, कुछ बात है कि हस्ती मिटती नहीं हमारी, सदियों रहा है दुश्मन दौरे ज़मा हमारा. With this kind of a backdrop, we have now to move to a newer and higher orbit. Together, we can redefine and transform the course of history to occupy our rightful place in the comity of nations. Thank you all for being with us here today. Thank you.